Leopold Aschenbrenner, a 25-year-old former OpenAI researcher, turned a 165-page technical memo into Situational Awareness, a hedge fund that surged from $225 million to an estimated $45 billion in just 18 months. Backed by tech luminaries like Stripe's Collison Brothers and the quantitative giant Jane Street, he reported a staggering 439% net return for the first half of 2026. His fund's strategy was built on the belief that the AGI race has just begun, requiring a huge amount of physical build-out of chips, power, and data centers. To capitalize on this, he placed concentrated bets on the infrastructure of AI companies, providing power and compute like Bloom Energy, CoreWeave, SanDisk, and SK Hynix, while betting against software giants like Adobe. However, this explosive growth was fueled by leverage reportedly as high as 4 times the fund's actual capital. Much of this risk was hidden from the public through total return swaps. It's a financing structure that allowed the fund to control a huge amount of stock without direct ownership. It creates a leverage trap where the slightest market dip could trigger a catastrophic chain reaction. By July 2026, the fund's portfolio was extremely top-heavy, with just 5 positions representing over 76% of its disclosed US holdings. The fund's collapse arrived in July 2026 when the AI infrastructure sector suddenly broke, with core holdings like SanDisk and Nebius plummeting between 48 and 56%. 4 times leverage, a 30% decline in the value of these stocks, effectively wiped out the fund's entire equity cushion, and it faced a long-short double whammy. Its long bets on infrastructure crashed while its short bets against software moved against them, forcing banks like Goldman Sachs and JP Morgan to issue huge margin calls. Endgame was a central bank credibility shock. On Tuesday, Citadel Securities head of macro strategy forecasted a surprise rate hike, driving 30-year treasury yields to their highest level since 2007. This macro pressure accelerated the sell-off in the very AI infrastructure stocks Aschenbrenner held, even though the Fed ultimately left rates unchanged on Wednesday. As of this morning, Situational Awareness was pinned and reportedly lost over $600 million in a single session. To avoid a systemic fire sale, Aschenbrenner unwound his entire public book in one block trade to guess who? Ken Griffin's Citadel. Irony is a masterclass in market structure. Citadel's own research helped bottom out the sector, allowing them to buy the portfolio at a really good discount. While Situational Awareness survives privately with a $5 billion Anthropic stake, however, if you see all the positions that were sold, they're all up. Proves that in a volatile market, the distance between a forced seller and a genius is only as wide as their margin cushion.